we have Viram Shah from Vested. Vikram is a co-founder and CEO of Vested, a company that aims to ease investing in US equities and ETFs for all Indian households. Vested was started in mid-2018 as an SEC-registered investment advisor offering zero commission investing into US. Viram started Vested while he was completing his MBA from University of California, Berkeley. We would also like to take this opportunity to thank Viram and the Vested family who have supported this event as a partner. Today, Viram has an interesting presentation where he would highlight benefits of investing into US and how it is in reach of every Indian through his Vested platform. Okay, Viram, I'm going to hand over the screen to you. It's all yours.
Right, thank you very much. I'm just trying to figure out how I can share my screen. Okay.
Yes, you are sharing the screen. We can see your screen. All is good.
Okay, perfect. Great. Thanks a lot for this opportunity. And it's great to be here. Thank you everybody for attending. Thoda to weird lag raha hai talking into a screen. I can't see anybody. I'm just looking into a webcam. So not able to get a sense of whether everybody's still tuned in or not. But hopefully I have some pictures, some interesting content in the presentation that can give you some new information or answer some questions that you might already have. So the focus for what I'm going to talk about is just generally how one should go about diversifying their portfolio geographically, and the US markets essentially as an avenue to diversify geographically and investing directly into the US markets, and what are some of the reasons why one should do it, and what are some of the myths that have been associated with international investing, and why we largely haven't been able to participate in international investing until now. I think Kunal's presentation was great, and I would describe this as opportunity 1.0 to essentially build a global portfolio for all of us Indian investors who've not been able to do so earlier. So just to begin, I kind of wanted to talk a little bit about diversification for people who are not completely active investors. The best way for them to build a well diversified portfolio is to incorporate four pillars of diversification. So the first one is asset class diversification. So essentially, you own different types of assets, for example, real estate, gold, equities, bond, and that is something that we have been doing pretty well in India. The second type of diversification is diversifying across industries. So you're not exposed to trends in one particular industry. So, for example, you want to invest some of your money in financial services. You also want to invest some of your money in pharma or technology. And that again, also we've been doing quite well. The third, which I think especially as investors in India are very familiar with and very good at, is time-based diversification. Largely because of the entire SIP awareness campaign, all of us have been doing time-based diversification, essentially investing at different points of time in the market and not putting all our money in one go. So that is pretty good. However, the last pillar of diversification that we believe has been missing in a lot of portfolios, we believe is missing in a lot of portfolios is the geographic diversification. So essentially holding a portfolio that invests into stocks, bonds, commodities, all asset classes across different geographies, so that you're not tied to a particular country or a particular currency. And that is something that I wanted to highlight today. So the presentation's title is Global Diversification via the US Markets. In our opinion, it's very much a need of the hour rather than a choice today. And if at any point you find anything interesting in the presentation, please tweet to us at Vested Finance. It's the only way we can get feedback in this online age and know what people find interesting, and so we can inculcate more of it going forward. So the handle is always there on the top right and on any of the slides. So please do tweet to us, and we'd love to hear from you. So quickly diving in, why is the US market the right way to diversify geographically? If you look at just from the point of view of the entire equity value that the US market has, it is about half of the globe's equity value. So at 40 billion, the US markets are approximately 20 times of the size of the India market, which is currently 3% of the world's total equity value at about 2 billion. So through the US markets, essentially, you get the opportunity to invest into one of the deepest, essentially, and the most liquid markets in the world. And for somebody who's looking for geographic diversification, we believe that anybody who is investing in the US market gets enough optionality to be able to diversify in an efficient manner. So then, just touching upon, so why should you be looking at US investing? What are the key reasons that one should think about even diversifying internationally? There are four key reasons that we believe people should do it. The first is you get to hedge against your currency exposure. So right now, if you look at most of our portfolios, they're all held in Indian rupees. And what has been happening over the past few years is that the rupee has been constantly depreciating. And so if you look at our wealth at a global level, the wealth is actually getting hit by this depreciation. So in order to hedge against this, the US markets, in which essentially you would be investing in US dollars, provide a good option. The second is global diversification, which I spoke about, as well as the different asset classes. So you get to invest not only in stocks, but there are a bunch of bond ETFs. You get to hold US treasuries if you want a risk-free asset, or you can hold corporate bonds of companies across the world, or you can also easily invest into REITs as well as commodities. So you get the optionality of not only diversifying in some of the best companies in the world, but also holding different asset classes. And I'll go into deep for all of these in a bit. The third is, so a lot of us are becoming more and more global. The coronavirus has sort of put a hit on travel, and we don't know how soon it will start. But the longer term trend is that people want to see more of the world. People want to essentially send their kids abroad for education or hold weddings abroad. So a lot of our expenditures are also starting to become globally relevant and US dollar based. And for that reason, you should have a currency in which you're saving, which is equivalent to your expenditure, right? And so that is why investing internationally helps save for that dollar spending. And lastly, this is research that we did. If you're investing into multinational companies who have their subsidiaries listed in India, तो फिर अगर US company में invest करो at the parent level, वो ज़्यादा efficient है than investing in the Indian company. So that is one of the things that we'll talk about in a bit as well. So the first reason that I mentioned, just purely from a return standpoint, if you're looking at the US markets, over the last 10 years, just on absolute return basis, the Dow, which is a Sensex equivalent in the US, has given about 200% returns versus the Sensex, which has returned about 150%. So this return that over the last 10 years, this outperformance we have largely seen because of the speed of technology innovation and the large tech companies that have grown globally and have innovated on their products consistently. And so that has translated into higher returns in the stock market as well. Now, if you add absolute returns along with the fact that the rupee, which about 10 years ago was at 50, and now it's even reached 76, 77 levels, the combination of both of these makes the return outperformance even more starker. So if you combine it, now bring them both into one common currency, the Dow Jones in the USD base gives the same return, about 200%. But if you're converting the Sensex into the US dollar and looking at returns, the returns almost half, they become almost 80%. So just taking a simple example, say you had invested about 4,500 rupees 10 years ago into the Sensex, you would have around 11,250 at a CAGR of around 9.6%. Your wealth would have grown at 9.6% every year. That same amount of money, had you invested it in the Dow in the US, you would have had about double the return at 16.5%, and your 4,500 would have become 21,000 rupees. And so That combination of absolute stock market returns along with currency depreciation is what allows this investment into international markets become much more lucrative than just comparing it directly to the Indian market. So that's the return standpoint. The second thing I wanted to talk about is just what are the opportunities in creating a geographically diversified portfolio, right? So I spoke about the pillars of diversification. Some of the things that you're essentially doing by investing geographically is one, you're moving away from a single country, single currency risk. So in a very global world, just holding one country can be something that becomes very dangerous. If something goes wrong in the country, then your entire portfolio suffers. Similarly, the currency also is something that if you hold just one particular currency, you're setting yourself up to be completely focused on that currency, which might not be the best way to create an efficient portfolio. So that's one, invest geographically and you can diversify your country currency exposure. You also get the opportunity to invest into global assets. So one of the biggest things that we talk about is that you're not, by investing in the US markets or getting access to the US markets, you're not in any way tying yourself to the US economy as such. There are companies there that are essentially global in nature, and so their revenues, their profits are related to the global growth that they see. As well as there are ETFs which allow you to invest in the entire world, or you can also treat country-specific bets. So, for example, if you want to invest in Japan, you can invest into a Japan ETF. Or there are, if you want to say you're long on emerging economies, you can invest into Indonesia, you can invest into a bunch of other Southeast Asian countries or Latin American countries. So basically, you can invest into the entire world. You also get a chance to invest into a lot of companies that have their ADRs listed in the US. So ADRs essentially American Depository Receipts. It's basically a company that might be listed in local exchange also offers these receipts on US exchanges. So a lot of China companies are there that you can invest into. So it's a global exposure that you're essentially getting. And lastly, as I mentioned already, the different asset classes. You don't need to tie yourself to one particular asset class. The other thing I wanted to talk about is, so diversification only makes sense if the two assets in which you're diversifying are not correlated to each other, right? It shouldn't be that one is moving up, then the other is moving up at the same time. That defeats the entire purpose of diversification. So what we've actually seen, if you look at the data of the returns in the last 10 years, again, comparing the Sensex to the Dow Jones, they both have a correlation of 0.4%. So of 0.4. So it means that basically 40% of the times both the markets are moving in tandem to each other, but at 60% of the times you get that diversification benefit. And so that allows you to essentially diversify away your risk and improve your risk-adjusted return. The other interesting opportunity is that the volatility is much lesser in the US market. So if you look at standard deviation of the Sensex versus the Dow Jones, just comparing over the last 10 years, the Dow Jones has a standard deviation of about 12%, whereas the Sensex has a standard deviation of about 15%. So volatility essentially hurts your returns every time they move up and down. Investing in a low volatility market essentially helps you improve your returns for the amount of risk you're taking, and that is the sort of the crux of building an efficient portfolio. The third thing that you should look at when you're investing geographically and the opportunity is essentially taking advantage of the different themes, right? So the one big theme that we've been missing in the Indian markets is technology. There is so much technology innovation happening. Famously, there's a dialogue that says software is eating the world. A lot of the tech companies are reaching now trillion-dollar market caps, but we've not been able to invest in that sector essentially in the India markets. So diversifying internationally through the US markets, you get the opportunity to invest into a lot of the leading technology companies. And so on the left-hand side, if you look at basically a comparison, this is a comparison of ETFs that invest in the technology sector. It's a Vanguard ETF compared to just the S&P 500. If you had invested 10,000 in a technology ETF 10 years ago, that would have become $40,000 right now, versus around $27,000 just for investing into the S&P 500. So if you want to get invested in the technology sector and take advantage of technology theme, then there is a great opportunity in the US markets to be able to do that. On the other hand, there are also a lot of emerging themes that are coming out. So there is a theme of artificial intelligence. There is a theme of cannabis. There are a lot of cannabis listed companies in the US. There is one interesting theme of CRISPR, which is basically gene editing technology for us to be able to become better humans over time. And so there are a bunch of companies listed on the US stock exchanges that are working on CRISPR. There are mobility companies, so of course there's Tesla, but along with that you also have a bunch of these different companies that are working on autonomous driving, self-driving cars, working on battery technology, which is at the cutting edge of their industry. All of those themes that you don't typically get to invest into in the India markets, those you can take advantage of via the US market. So you can basically build your wealth over time as these themes play out. The third point which I was talking about was it's great to just invest in a currency in which your expenditure is going to be like, right? And so these are the three things that we believe is that we've seen in our user base as well is the biggest kind of goals that people have. Foreign education, which is quite an expensive affair. I had gone abroad to study, and I wish my father had saved in US dollars because I saw that wealth that he was targeting over time was reducing because of the rupee depreciation. There's weddings that you can do abroad and traveling. Essentially, if you travel 2 to 3 times in a year, you are anyway getting US dollars for that expense. So saving in that US dollar wealth would be much more beneficial for these global expenditures. And lastly, talking about investing in the US becoming more efficient. So we basically looked at US multinational companies that were publicly traded in India. So you can look at Unilever, you can look at Colgate, GSK. If you compare their PE, so the India listed companies PE versus the US listed companies PE, the parent company, the PE of the India company is 3 times of the parent that is traded in the US. And naturally, then you would expect if you're paying 3 times more money for the same kind of valuation for the same price, you would expect that you would get 3 times more return, right? However, if you compare the returns, there is not a significant difference in the return profile of these companies. The companies in India, these listed subsidiaries in India give a return of about 17% versus the US parent that gave a return of about 14%. So if you are looking at these particular companies, then it's just way more efficient to invest directly into their parent. Now, I'll quickly touch upon what are the regulations that are applicable as an Indian investor, right? That is one of the biggest things that we need to take care of. And the first thing that comes to mind is taxation. How does taxation work? मुझे कहाँ पे tax भरना पड़ेगा? Capital gains कहाँ पे होगा? Dividends कहाँ पे जाएंगे? So essentially, capital gains are all payable in India, and it's treated as the same way as unlisted shares are treated. So 24 months is the threshold for long-term capital gains, the rate of which is 20% with indexation benefit, and short-term is according to one's income tax slab. In terms of dividends, so there is a withholding in the US of about 25%, and because there is a agreement between the US and India, a double tax avoidance agreement, you can get credit for the tax that you paid in the US while filing for your India taxes. So that is one thing that you can take advantage of as well. And one of the things that we do at Vested is basically help simplify this, because it seems very complicated, but once we actually simplify it and use technology to do it, it becomes much easier. The other thing is, are we even allowed to invest, right? So on the India side of things, the RBI has a scheme called the liberalized remittance scheme, which has become more liberal over time as well. It was they have a upper limit to how much money an individual can transfer outside of the country. And so when they started in 2013, it was $75,000. In fact, before that it was 50,000. Then it moved to 125, and now it's at $250,000 is what you can invest internationally. So for a lot of us, that is enough of a limit to be able to invest internationally, and they are very clear as to what you can and cannot do. And for investing internationally, they have very much said, especially in the public markets, you can do it. There might be a couple of declarations that banks require, but once that is done, it's a very streamlined process. Some of the banks have even taken it online, so you don't even need any more paperwork to be able to transfer funds in US dollars to start investing. On the US side of things, just a quick overview, we are registered with the regulator there. So the SEC, we are registered as an investment advisor and provide certain levels of advice to anybody who uses our platform. And over time, we look to become a broker as well in the US. Lastly, there are a couple of things that I wanted to, a couple of myths that I wanted to bust and just touch upon why we haven't done this until now, right? So one of the first ones that I wanted to talk about is essentially that there's a myth that local ETFs provide good international investment opportunities. There are a few ETFs that do investments in the indexes in the US, or there are a few mutual funds as well that have some exposure to the US. In terms of ETFs, there are a few things that one should be aware of. One is that if you're investing in these ETFs, you're essentially paying a much higher fee than you would if you're investing directly. ETFs are essentially supposed to be instruments that allow you to invest it at, say, 2 or 3 basis points or 4 or 5 basis points. The fees should not be really high, then it defeats the entire purpose of an ETF, right? Because it's just mimicking a benchmark. So in terms of expense ratios, if you're investing in the local ETFs, you pay about 0.5 to 1%, whereas the same ETFs available directly in the US market are actually 0.03 to 0.05%. So they're way more efficient if you're investing directly. There also ends up being some kind of tracking error. So because there are certain requirements, like you need to have a certain amount of cash left just to ensure that there's enough money for withdrawals, or because of foreign currency fluctuations, there ends up being some tracking error. What we've seen in the NASDAQ 100 ETF is there's about a 2% difference in the annual returns that you have gotten over the last, I think, 9 years since it's been around. And over time, that cumulatively becomes a 20% loss of returns. And so that's substantial if you're investing over the longer period of time. Taxation-wise, also, local ETFs are essentially treated as debt funds, so the longer-term threshold is higher. It's 36 months compared to the 24 months for direct investments. And lastly, I think this is the most important thing. When one is investing internationally, you definitely need to think about how you're allocating your assets. Just purely holding an index fund and thinking, "Arey, ho gaya, international diversification is done," in our opinion, is not the right way to do it. It does not give you the most efficient risk-adjusted return. You're taking a lot of risk by investing just directly in an ETF and holding equities. There are much better ways of building the same risk profile portfolios by diversifying across equities, bonds, and commodities, and that is only available if you invest directly. So that is one thing you should definitely keep in mind if you're building your international portfolio. The second myth that we come across, and that what a lot of people think is the issue with direct in US investing, is that it's बहुत complex, it's very expensive, it's hard to use. Under complexity, people feel like taxes are very difficult. Wiring USD is going to be very difficult. You don't want to go through the hassle. It also is super expensive, is what people think. You have to pay commission, and this used to be the case for a long period of time. There used to be minimum deposit requirements as well, and the other big barrier was say you wanted to buy Amazon. Now Amazon shares are around $2,000, which is 1.5 lakh rupees just in one share, which becomes very expensive, and so a lot of people could not even start investing. And the third thing was that it's super hard to use. There is paperwork involved, and so basically people would give up on direct investing. However, now what has happened is there are options, and Vested being one of them, that allows you to essentially do all of this in a much easier manner. You can open a US brokerage account sitting at home completely online in 3 or 4 minutes. Your fund transfer, depending on the bank, the process is easy. There are some banks which allow it completely online as well, so you can do it easily. You can bring the money back if you want directly into INR in your bank account in a much easier manner. Also, what has happened is commissions have gone down. So essentially, we at Vested don't charge any commission. The US brokers have, all of them, the large ones, have also gone to a zero commission model, and we believe that's the one that is going to sustain over the longer period of time. So only monetizing value add services such as advice is what we do. There are no minimum deposit requirements. Also, you can fractionally invest. So you can literally invest $1 into Amazon and hold those shares for however long you want. So the entire end-to-end process has become much more simpler. Even tax reporting is something that we have simplified, and so you don't need to worry about how you will pay taxes. And the last thing that I think I wanted to touch upon was, so why is it that a lot of us have been hesitant to do international investing, right? And so there is this concept called home bias, and it's basically a phenomenon where investors prefer to invest in their home country under the belief that they know the stock market, they know their local stock market much better, and they overestimate the risk of investing abroad. Basically such a belief leads to a suboptimal portfolio. You essentially might end up taking way more risk than if you were diversified internationally. It's basically the concept is you feel like you know the markets and that you won't be able to know the international markets as well. However, if you just put in a little bit of effort to understanding how global markets are, this home bias is something that can be removed and you can create a much better efficient portfolio. Great. I think that's pretty much it from my end. If you have any kind of questions or if you have any kind of doubts, then please do reach out to me directly. Our website's listed there, and you can always tweet to us and we'll be happy to respond.
Okay, Viram, we are just taking in a few questions. I'll just give a couple of minutes to our audience for them to send the questions. So guys, if you have any questions for Viram, he will be more than happy to answer some of them here. And if, of course, if we run out of time, then we'll take those questions offline as well.
Yeah, I think one thing I can additionally clarify also is that the trading is not allowed in the international market. So that's one question that we get very frequently. We trade in the US markets. And so the RBI has not allowed anybody to invest into speculative products. So essentially FNOs are out of question, and you cannot take margin as well. So it basically acts as a barrier to trading. However, you can buy and hold for a longer period of time. So more as a wealth creation opportunity.
Okay. Cool. So that's good to know. Okay, so Viram, we have a couple of questions. One is, how about the regulatory risk from local and US governments? So what's the regulatory risk there?
Yeah, so I briefly spoke about regulatory. I mean, it's from the US side of things, there are no issues at all. Almost the entire world invests in some of the companies that are listed in the US. From the India side of things was something that is very unclear for a lot of people. And so there, everybody is essentially allowed to invest up to $2.5 lakh. There is no restriction there. And taxation wise also, it has been clarified as to what are the taxation that is applicable. And as long as those are filed appropriately, there are no issues there.
Okay, great. Okay, and there's one more question where, okay, so can you reiterate on the brokerage fee and taxes for Indians who want to invest into the US markets? That is one question. And the second part question is, apart from US, any other international markets that they can currently invest in via Vested?
Yeah, so in terms of taxation, this is what it is. So it's basically 24 months is a long-term threshold, after which the rate is 20% with indexation benefit. And there is no, in terms of short-term, there is, it's according to one's income tax slab. In terms of dividends, there's a 25% withholding. So the dividends are directly credited into your brokerage account. So if you have a vested brokerage account, they come into your brokerage account directly, and you'll see them as US dollars. And so there's a 25% withholding whenever they are credited. However, you can get credit for those dividends here in India. So that is how the taxation structure is. In terms of commission, so Vested is completely commission free, and we don't charge anything on buying and selling per trade. We charge if you invest into any of our pre-built portfolios. So if somebody wants advice, then we have that as our paid feature. However, in terms of commission, we don't charge anything.
Okay, great. And apart from the US, if there is any other international markets that we can currently invest in?
So directly into the markets, not really. We've only plugged into the US markets. However, as I mentioned, the US markets have firstly a lot of companies that are listed in global exchanges that have these that are listed on the US markets as well. For example, Alibaba is one such company that's listed in the US as well as in China. And there are ETFs available that allow you to take country-based exposure as well. However, if you have particular companies that are just listed on local stock exchanges, then those will come in the near future, not currently.
Got it. Perfect. Makes sense. Okay. Thank you so much, Viram, for joining us. Once again, we would like to thank you not just for telling us how we can invest in the US markets, but also for sponsoring our event. So thank you so much.
Perfect. No worries. It was a pleasure interacting with everybody, and thanks for organizing such a great event.
Great. Thank you so much, Viram.